The FBT exemption is a powerful tax incentive, but the rules for 2026 have shifted dramatically. Getting this right lets you completely avoid the massive 47% tax rate on company cars. But a popular type of vehicle has now been cut from the scheme, catching many off guard. And one small detail from a vehicle's past can permanently disqualify it, regardless of price. We'll break down what qualifies in 2026, the hidden financial traps, and how to stay off the ATO's radar. Let's get straight to what's eligible. For 2026, it's only zero-emission vehicles, full BEVs, and hydrogen. The vehicle's initial sale value must be below the luxury car tax threshold, which is $9,187 for 2026-27. Critically, if LCT was ever paid on the car, even by a prior owner, it is permanently ineligible. The vehicle must also have been first held and used on or after July 1st, 2022. This opens the door for qualified used EVs, so it must be a BEV or hydrogen first used after mid-2022 and never had LCT paid. Now, why is this so powerful? The biggest savings come from salary packaging. By paying from pre-tax salary, an employee can slash ownership costs by 30-40%. For the business, the benefit is direct. You avoid paying FBT at the top 47% rate. A tax liability becomes a cost-effective perk. And the exemption isn't just for the car. It covers running costs like registration, insurance, servicing, and even electricity. Look at the PHEV cutoff. A binding lease signed on March 30th, 2025 is fine. Sign that same deal on April 2nd, and the exemption is gone. Another common error is assuming dual cab utes are exempt. They aren't. They have separate rules requiring proof of limited private use. With all these savings, it sounds almost too good. But is there a hidden financial catch for the employee, even with a zero FBT bill? The financial case is strong, but precision is needed. Now we cover the complications and compliance burdens the ATO is watching. Here's the catch. Even with no FBT paid, it is still a reportable fringe benefit affecting HEX debt, child support, and family tax benefits. Another detail, charging electricity is covered, but the home charging station is not. A business paying for a wall charger is a separate fringe benefit. Looking ahead, the whole exemption is under government review. A decision on its future is expected by mid-2027, creating long-term uncertainty. Remember the huge 47% tax saving? That makes this a prime target for the ATO. They know the financial stakes are very high. The ATO now uses data matching and analytics to find employers who get it wrong, specifically targeting claims with poor vehicle use records. Including running costs like electricity is a huge plus, but it demands proof. Strict continuous record keeping is not optional. The ATO offers a shortcut for home charging at 4.2 cents per kilometer, but you must still have accurate odometer readings to prove the distance. The mission is to secure a major tax benefit while being ready for intense scrutiny. So how do you build a bulletproof 2026 strategy? Let's recap the core points. 1. Your vehicle must be a battery electric or hydrogen fuel cell model. 2. It must have always been under the luxury car tax threshold. Its sale history is permanent. 3. The benefit is huge, but remember it's reportable and can affect an employee's personal finances. And 4. The Australian Taxation Office is watching. Your only defense is ironclad record keeping. This FBT exemption has been a massive driver of EV adoption in Australia, reshaping fleet and employee benefit decisions. Understanding these rules, the benefits, the exclusions, and the risks, is mandatory for any Australian business in 2026. Since every business situation is different, speak with your accountant or tax advisor to apply these rules to your specific needs.